Welcome to the Jamaican Investor. I'm your host, Arain, and thank you for tuning in for another episode. Today will be a more casual video, just going over some of the things I've learned from investing so far and things I wish I knew when I initially started my investing journey. I started my investing journey back in July of 2020, so it's been around 1 year and 3 months since I started, which hasn't been that long to be honest, especially in the world of investing. But I still think it's worth the time making a video to talk about some of the things I've learned over the past year and mash. To the seasoned investor, some of this info may be a no-brainer, but to newer people such as myself, the learning curve can be pretty steep and it can feel like an uphill battle trying to figure things out. With that said, I hope everyone new and experienced in the investing world can enjoy the video nonetheless and draw parallels to their current and past situations respectively. If you enjoy our content, leave a like and subscribe as it greatly helps the channel, and turn on post notifications to be notified the next time we post a video. Remember as well, none of the information in this video should be taken as financial advice and is for information and entertainment purposes only. Please consult a licensed financial advisor before making any decisions on how to manage your money. So the first important thing I would say I learned when I started investing is you don't actually lose money unless you sell for less than what you bought in. Now I know what you might be saying, Arain, that's pretty obvious, right? Well, wrong. A lot of new investors see their portfolio go red and think it's the end of the world and that they just lost all or some of their money and need to minimize any further loss. This to me is akin to catching a falling knife. You see, losses experienced on stocks that haven't been sold are unrealized losses, meaning you haven't really lost any money, and if you're patient and in it for the long term, which you should be, then it's simply a minor setback and will oftentimes be as a result of volatility or short-term events. What we do wrong as investors is looking at short-term events and shocks to the market and make long-term decisions based on that when it should probably be the other way around. Furthermore, as humans, we often look at the downturn in one of our positions in the market as a sign that we did something wrong, and then try to correct that by selling the asset to fix a mistake we believe we made. It is for this reason that any investment we make should be thoroughly researched to prevent us from looking at unrealized losses as being definite, as we don't actually lose any money until we sell below our buying price, fees considered. The next thing I've learned is that nominal prices of a stock or asset are less important than the actual underlying value of the asset. What we mean by this is whether a stock costs $500 or $5, its value is based on the underlying profitability and efficiency of the business, not the nominal price. Now, it's completely understandable, especially from the perspective of a new investor with limited capital, why getting a 100 units for $5 may appear to provide more value than 1 unit for $500. But it's this type of thinking that may prevent you from identifying exceptional or valuable businesses relative to their price. I know from my experience, I thought like that when I initially started, and that prevented me from capitalizing on some businesses that had major upside relative to their price at the time. Oftentimes, then investors can be blinded by the nominal value of a stock and associate a higher nominal stock price as an indication of a better performing business and a lower nominal stock price as the indication of a poorly performing business. This can't be any more further from the truth, as similar to any other market based on the laws of demand and supply, it is subjected to the irrational behavior of humans. So my tip in regards to the nominal price is to not put too much emphasis on it when the value of a business is being considered. The third thing I've learned from investing so far is dollar cost averaging can significantly impact returns. When we talk about dollar cost averaging, we are referring to the process of buying into a specific stock at various price points over an extended period of time with the hope of lowering the average cost of each unit of that given stock. Essentially, if you are able to enter a position in the market at a lower price, then the overall cost of each unit will be lessened. For example, say you initially invested in Brian's bookstore at $10 a share and later you bought in at $5 a share. Then on average, considering you only bought 2 shares, you would have spent $7.50 per share. What this then does is reduce the burden of the loss you would have already experienced from the stock moving from $10 to $5, as now instead of it being an overall loss of 50%, it has become an overall loss of 25% on average. Basically then, dollar cost averaging can be a means of reducing your downside and optimizing your upside, especially in the case where you are investing in a business that in the long term will do well. The last point I wanted to cover for this video is something I found really interesting when I realized it, but if a stock goes down by a given percentage point, it has to go up twice the percentage point to return to its original value. For example, if a $100 stock goes down 50%, it would have to go up 100% to return to the value it was before it fell. What this means is that stocks will oftentimes seem to recover far slower than they initially took the decline. This is an interesting phenomenon as from a psychological perspective, a lot of investors look at returns and losses in percentage terms, which can downplay losses and cause gains to seem far more significant than they are, and vice versa. For this reason, it may be wise to consider price history before focusing too much on daily, weekly, and even monthly percentage changes, as this may give a better indication of how a stock is performing and how volatile it may be. Well, those were just 4 of the many things I've learned investing in the stock market so far, and I look forward to learning much more as my investment journey continues. I guess ultimately investing boils down to both financial competence and psychological flexibility, and for me it has been a great tool so far in increasing my financial well-being. I look forward to seeing your opinion in the comments below, and I'm also thinking of making a part 2 to capture some of the other things I've learned that weren't included in this video. Once more, thank you so much for sticking around until the end of the video, and I hope this information was useful to you. If you enjoyed our content, leave a like and subscribe for more videos just like this. Also, check us out on our various other social media platforms, which will be linked below. Again, my name was Arain. Stay financially conscious, investors.